And call the investment committee to order. We're doing this on a Wednesday morning. I just want to note that we've made some changes, obviously, with our new year in September, where we've switched things around. So certainly want feedback from board members on how this works. But the plan is to have, a full day for our investment committee. No rush, no planes to catch. So we're going to jump in. We are going to do our first item, approval of committee agenda in open session, then move to closed session. So could you call the roll, Lamont?
Yes. Controller E. Here. Mr. Unterman. Here. Treasurer Chung. Good morning. Ms. Vargas. Here. Mr. Rosensteel. Here. For the State Superintendent of Public Instruction, Ms. Zumot. For the Director of Finance, Ms. Ortega. Ms. Higa. Mr. Keeley. Madam Chair, you have a quorum.
Excellent. Thanks, Lamont. So our first item in open session is approval of the committee agenda.
I'll move.
All right, it's been moved and seconded. All those in favor say aye. Aye. Opposed? Any abstentions? Excellent. Okay. That is the end of our first, our open session item. I did want to just make one mention quickly about our colleague Terry McGuire, who has been a representative for the Controller's Office for the last 7+ years. And he has, I don't know if it's official or not, but he has retired. I put it in quotes because we never know what he's up to. But I guess, I have been on the board for 3.5 years. He's an active guy. And those of us who have had the privilege of serving with Terry just know him as a really prudent, thoughtful, intelligent board member who's contributed a lot to the conversation. And I think, former Controller Chung, working with him, has been a faithful representative of the Controller's Office. And so I just wanted to publicly thank Terry for his service. He'll see it on, on the webcast. And also, it looks like Betty also wants to say a few words. So, but thank you, Terry. Betty.
Thank you, Madam Chair. Yes, and really want to just publicly note his tremendous contributions with the transition into our control administration, but I can assure you that he will not be retired from the whole pension fund.
I thought that might be the case.
And that his contributions really have had sustaining effect with respect to, I think, for many of us in terms of how we've been thinking through some of these issues, particularly around some of the actuarial assumptions, the conversation we just had this morning in audit and risk, as well as around issues of liquidity and just being ahead of the curve on some of those discussions.
Absolutely.
Thank you.
Great. Thanks, Betty. Don?
Yeah, so Terry's absolutely fantastic. I wouldn't call his state days done. We're going after
We've
him.
heard rumors. We've heard rumors. I have not confirmed them yet. I figured so. Awesome. Great. Thanks, John. Excellent. All right, with that, we're going to go ahead and adjourn into closed session. So if I could have Jack, Brian, can you do a little scan around the room, make sure we have everyone in here that's supposed to be in here, and anyone that from the public. We welcome you back into open session. And we'll try and keep you posted on timing for the open session so that you know when to come back and join us. Thank you. All right, let's go ahead and call the investment committee back into open session. And it wouldn't be the investment committee if we didn't switch around the agenda just a skosh. So I wanted to, let's see, I conferred with our CIO. How we're going to do this is we are going to have hit the CIO report, item 8. And then we are going to our big item, item number 10, our asset allocation study. And then we will get back to the rest of the agenda. So Chris, you are up. So again, we're on item 8, the
Yes.
CIO report.
No, I've got that.
We
Thank
will
you
not
very
forget item
much.
7. We will get there. We're just going to reorganize.
Yep. So before I go through the slides, a couple things I want to highlight in the report. The month of August obviously was a very difficult month. The U.S. equity market dropped 6%. The emerging markets actually dropped 9%. And calendar year, so 2015, the U.S. market is now flat. Today we were up, so we're slightly positive. But the emerging markets are down 13%. So it's been a very tough year for non-U.S. and for the emerging markets. And a couple things I want to highlight. If you would turn to INV 25, this is the snapshot I take of the PCA risk report. It's been like this for a while, but I just really wanted to draw your attention. The upper box, the three asset classes that we would consider unfavorable pricing. In other words, they're very rich in price, which is the U.S. equity market. We knew that. This is from the start of August. But also the private equity market and the real estate market. And I'll highlight that in the performance reports if we get a chance, what I call the two scariest graphs to me in the semi-annual performance reports. And then in the lower box, it was very interesting. At the beginning of August, you can see the bottom circle, equity volatility was at nearly an all-time low, bottom decile. Boy, did that change in a heartbeat. It's still, when you look at a full calendar year, it's still very low relative to history, but obviously we've been on a heck of a roller coaster ride in the last month. Inflation, ridiculously low, almost negative, and you're hearing a lot of people worry about deflation, which is a huge risk. And then finally, interest rate risk, which we've said for a while is near an all-time high because the interest rates are so low. And then if I can have you flip over a page to INV 27, I am going to embarrass somebody. Josh Dietrich, you're here. Can you stand up? And your team, is the rest of your team here or they're upstairs? So Stephen, stand up. Under Stephen Tong's leadership, Josh Dietrich, they have created this new risk report, and I'm very proud of it. So thank you, guys. We're going to be expanding it. This is coming from our new risk system that we have put into the portfolio. So what I want to draw your attention to is on the bottom left corner of INV 27, that's a different way to look at the asset allocation, which is from risk factors. And that's going to fit into our asset allocation discussion in a minute. But look at the very two bottom slices of the pie, equity risk private and equity risk public. Add those together and you get 79%. So basically 80, and that's what we've said all along, 80% of our portfolio is driven, I'll call it GDP risk. Think of economic growth risk, not only here in the US predominantly, but also around the world. That's what we're going to focus in on the portfolio. And you're hearing more of our peers talk about looking at their asset allocation through risk factors. It's work that we did, gosh, 3, probably 4 years ago. And so we're going to show you those two slices all the time. First, how it looks on asset weights, but then how it looks on risk rates. And then if you flip it over to INV 28 and 29, I'm going to get into this a little bit in the slides, but first off, they're showing you our top 10 holdings in all the portfolio and all the different parts of the portfolio. The first thing on INV 28, you can see major exposure is really to the USA, and then secondarily, UK, Japan, Germany, France, Canada. Places like Australia, China, and the emerging markets are very low. So we talked earlier about China being the number 2 economy in the world, but right now we have about 0.5% of our total portfolio exposed there. The UK used to be the number 2 economy in the world. In Japan, we've got almost 5% of our portfolio overall exposed into those markets. So China has certainly emerged, but it is not a major part of our portfolio. Then I want to point out on INV 29, and I'm not going to do this every time, I just want you to kind of pick up, if you're looking at this, what should grab your eye. INV 29, these are the top 10 holdings in the major asset classes. And so look down at the very bottom under the top 10 for the percentage of the portfolio, and that gives you an idea of the concentration. So I'm looking at global equity, top 10, 8.76% of the global equity portfolio is represented in these top 10 stocks. It's a very diverse portfolio. You already know there's almost 4,000 holdings in that portfolio. The top 10 is almost 9% because it's big, but it is a real long tail. And Margot used the example of Apple in the back earlier today. Just for the record, we have about $2 billion of equity in Apple stock. Look at the concentration in fixed income, a very opposite story. 60% of fixed income is made up in the top 10 holdings. Almost all of that, 55%, is U.S. governments. So it really skews the number. When you look at private equity and in real estate, you can see those are concentrated, but realize those are exposures to managers. So Blackstone Capital Partners 5, $1 billion, but that holds about 15 different companies beneath that. And then likewise on the other line, the fact that Principal Real Estate has $3 billion, 13% of the real estate portfolio. That is a diverse portfolio across the USA of properties and property types. But we do have manager concentrations in both of those areas. And so those are things to just kind of keep an eye on. Before I jump into the slides, I want to be able to introduce somebody to you. I sent you an email because we're very pleased, but I want also the audience in the back of the room to at least get to meet her. The board in the offsite last year created a stakeholder engagement position. It always takes time in government to get wheels moving, and our schedule is darn busy, but we found the right person. So I want to introduce a portfolio manager from CalPERS. She's still at PERS, but is coming over to join us at the end of the month. Her name is Geraldine Jimenez. Geraldine? So I'm very excited. She'll be definitely your point of contact on a lot of issues and a key point for the investment office, a point of contact on all the external issues that pop up. She'll team up with Gretchen Ziegler to really put the communications together and help get information. When something breaks in the world and on the portfolio, she'll get that information assimilated on our side and put the word out to you about what we have and where we're exposed. So.
I'm going to let a couple folks jump in. Tom, did you want to jump in?
Yeah, I was just looking at INV 27, and I do think this looking at the portfolio by risk is really interesting. I wondered if you have the ability to extend it in ways that say, I'd like to see how much of the portfolio is principally driven in value by interest rates. Yes, we can do that, interest rate sensitive. Price of oil, another driver. But so basically external risk to the investment
That'd be interesting.
category.
Josh is telling me through our secret communication line, we can do sensitivity. Oh, we're whispering. We're going to be on the internet for whispering. Yeah, Josh says we can do sensitivity analysis so they can show, I assume, price of oil. It's a very nice, robust system, so I really want to push it to the limits.
Good.
So
Yeah.
give us your ideas and we'll run it and we'll send you that information.
Can we do that?
Terry, we cannot run the sensitivity to New York Jets fans. I'm sorry. That wasn't the question.
Wasn't
So-
funny either.
Don't make fun of his Jets, Chris. He's very
Ow.
sensitive about that.
The beginning
okay?
of the season.
Very sensitive.
Ow.
Hopeful.
It's a sensitive time, September. So,
Am I turning red?
Tom, can we make that a information request for November, or is that something?
Well,
or how do you
I
want to
didn't
do it?
have a specific thing in mind, other than I know some people have looked at their portfolios with respect to oil, because it cuts across a lot of asset classes.
I'll have them run it through a couple of different sensitivities, and we'll pull out some of the biggest ones that give you useful information and include those in the next report.
Okay.
John?
Just to Geraldine, welcome aboard. So, she did great work across the river.
Excellent. Yeah, she's come highly recommended by many people. Many people have reached out when the announcement was made, so we're really glad to have you here. Harry?
Thanks, Madam Chair. So, Chris, you mentioned that your staff will work on some of that sensitivity analysis. I'd like to just put in one specific request. Tom mentioned oil, and if it's okay with the committee, at some point, it's certainly not sensitive to time, but this fiscal year, I'd love to be able to see some sensitivity analysis around a rising interest rate environment, as opposed to the environment we've been in for an extended period of time. What type of risks and exposure and opportunities would present themselves in a rising interest rate environment?
And I think what we can do is twofold. One, in a slow rising interest rate environment, and then also a fast rising interest rate. I wouldn't expect the fast one, but that's the one that has the biggest shock on asset prices. Okay?
Thank you.
So let me run through my slides real quick, and next time I'll include that New York Jets slide. Harry let me update these, which is sadly for Friday or Monday's close.
Let's not even go there.
Okay, Monday's close. So obviously last week was a very roller coaster week, but neutral. Monday was obviously a huge sell-off. We rebounded some. I didn't see where we closed today, but we rebounded some today. But at least at August 31st, our assets are about 184 billion, down from where we were at June 30. Almost all of that occurred just simply in the month of August. There we go. So here's the asset allocation mix that we looked at earlier. As of just rough, this is unaudited and reconciled. We're still, as you can see on the graph on the right-hand side, pretty much on target within U.S. equities. We're now higher in fixed income because the overall portfolio diminished a little bit. And then pretty much on target everywhere. The only place we're underweight is still in private equity just because of the long-term capital flows. Here's a graph of the Russell 3000 since June 30 of 14. So this is a year and a half. I wanted to highlight the bottom. We went back and tested this low in October of 14. The market held in there, at least initially, which was a good sign. And as we've done earlier, we need to back up and look at that. So here's the bull market, as we would describe it in U.S. stocks. March 9th of 2009 was the low in the S&P 500 at I think 666 was the number. This is the Russell 3000, but at least it gives you a perspective of where the last month has been relative, and that's why we said the market was getting long in the tooth. You can see the slope really flattening out as we got into 2015, and that's kind of that classic sign of a market petering out. Doesn't mean we're going to have a bear market, but it certainly means we might be in for a more volatile period. This is backing up and looking at the world in the MSCI World Index. So this is the entire world, including the USA. So the US is about 50% of this index. You can see the world markets have been much more choppy. They did set below their low in 2014 and in October of 14 and have not held that ground. Here's that same chart, again, backing up and looking at it since the bull market started in 2009. The U.S. is the one dominant market that's taken it higher, but you can see the non-U.S. markets have really been a bit rougher since the Great Recession. But you also, again, can see that perspective of we've set back to lows that we hit in 14. We haven't given up at all the bull market. And I think it's going to continue to waffle in here. Here is the what I will call the culprit. Tonight is their last trading day of the week in Shanghai. They have announced a 2-day holiday parade. It's as somebody said, it must be a very long parade. It takes 2 days. But this is the Shanghai Composite. This is only available for certain qualified investors that got special permission, like British Columbia, but mostly just retail investors in China. So you can see the most recent volatility in that market, but also realize that, just in the last year, since September of 14, there still has been a tremendous run-up in this market. So that market from roughly last year on this meeting date climbed 135% by basically the middle of June. I think it was June 16th. Since that time, it's fallen 43%. That's what's gotten the world so excited is the volatility of that market. And as we've discussed, it really is just the risk that China might be slowing down to about a 3% growth rate versus the 8% growth rate, and leaving questions about whether it's going to have a hard landing. So the volatility here in this market that most people can't invest in touched the rest of the world. As I showed you, it spread across Australia, Japan, then India, and it followed the sun across the globe most of last week, where then, as Eastern Europe and Middle of Europe opened, the Middle East, and then the UK, and then finally the USA, That's the market that people are watching, and we'll continue to focus on that China would hope to stabilize. And I think we have to put it in perspective, which is if you invested a year ago, you're still at a profit. You just gave a lot of your profit back. So this is similar to the chart that's in your book, but this is a picture of GDP growth and the IFM forecasts for where growth will likely come. The USA, very slow, but still in the positive green. And you can see certainly the resource-rich areas of Russia and Brazil, Argentina are the areas where you're expecting more of a recession. And they had put China at the idea that it would be flat. We'll never know because obviously China controls the economic reports that come out from their government, and there's a lot of suspicion about the quality. But certainly China has slowed dramatically, and the question will be the hard landing. If you overlay this chart with our asset allocation, that gives you a rough idea of where we're buying and owning GDP growth and where we have no exposure. So obviously sub-Saharan Africa is expected to grow at double digits. We don't have any exposure there. Our exposure is really primarily the US and UK and Japan. So when I climb up the crow's nest and look out on the horizon, the risks are pretty similar to the way they have been. Obviously, China's economy, more so than the market. Our central banks move. As somebody said earlier, I believe it was Alan, we've completely stopped talking about Greece, but Greece still does matter. It's getting out of the woods, but it's not out of the woods. And then obviously where our Fed goes, does our GDP stay at 2% or does it go lower? Or does it actually climb higher? And where do we go with interest rates? So I'm going to, as a long-term investor, I keep telling people, focus in on the USA. Sure, China's giving you a lot of noise, but look at the internal dynamics in the USA and, things are still okay. The Goldilocks economy that we used to talk about in the spring, about not too hot, not too cold, just okay. And the Federal Reserve will raise rates. The capital markets will react to all that, but what we want to look at is corporate earnings and how things stay on a steady pace. So there we go. Any questions?
Questions from committee members? No questions. So thank you, Chris. Great. We're jumping to item 10. So we'll have the asset allocation study, part 5. I feel like we're, the sequel. It keeps on giving.
The team is coming forward. So apparently there was a lengthy article in the Wall Street Journal today on us. I didn't know that. As Tom said, it said big fund considers big moves, and he thought it was talking about CalPERS. So it's talking about us. But what I've tried to emphasize to our local press who's here is that this is really more of a broad discussion. You do not have to take action today. If you're ready, you can. A couple things I want to highlight. I was very proud of this paper. We delegated to Stephen and Josh and Carrie to really take on this project of the asset allocation. As we were talking earlier, this is basically advanced undergrad. I'm going to say it's basic grad school type of asset allocation. So it was meaty. I'm sure it was a tough read for some of you. If you really enjoyed it, then you're part of our world. Yeah, some people did, but I think Josh did a really great job of trying to crystallize. I always tease Josh is a math econ double major, so I'm always trying to get him to write in plain English. But the two things I wanted to highlight, guys, and I'm probably stealing your thunder, so I'm sorry, but you're going to hear us talk for the first time about ETLs. When you think of ETL, just think of tail risk. If you took statistics, think of kurtosis, which is that left-hand tail. We don't care about the right-hand tail. That's all good stuff. I guess for you guys, this is the right-hand tail, and the left-hand tail is bad stuff. We care about the bad stuff. This fund does have ETL. We do have kurtosis. So, and that showed up in 01, and it showed up again in 08. We do really well in good markets, and we really get hurt in recessions. So that's something to think about minimizing. The other is where Josh talked about the 10th percentile of 2046. it's probably not a great analogy, but I would think of it as that's setting the percentage of the worst possible outcome. In other words, you want to reduce the worst possible outcomes. You can't eliminate them all, but you want to really reduce those. So when you look at that number, think about how can I get better chance of having a funded status in 2046, because the goal of this exercise is to set your risk temperament. Short-term volatility versus long-term funding risk. From there, it will tell us what kind of a return to shoot for. So that's Stephen. I pass this to you.
I'm just going to mention for the sake of the investment committee too, just, there are two things. One is the portfolio allocation options that we'll hear from our consultants about, and then also the risk and return of the different portfolio options that our consultants will. So those are the two things that, and remember, this is an information item today. We're not taking action on this item today. So go ahead, Stephen.
Thank you, Madam Chair. Just before I begin, I'd like to have just a couple introductions. You heard Josh Diedisch. I just want to let you know he works in the innovation and risk. He actually leads the risk effort. And so some of the risk reports that Chris, you saw in the CIO report, is actually generated by Josh and his team. And then to my right is Carrie Lowe. She works on the innovation program, and she's a lead portfolio manager. Just by the way of material, as you recall, the asset liability study started in February of this year. And I actually took account of the amount of volume materials that you read. And to date, through September, you've read 217 pages of material, written material, charts, and graphs from the consultants. And then in addition to the 217 pages, staff has written 35 pages. So a total of 252 pages. And in terms of staff's role, we felt our role was to really help assist you in navigating through these really difficult, complex, things that are difficult to understand, and really help compare the two recommendations that you're hearing from your consultants. So today, you'll have the opportunity to review the results from the models that were run by both your consultants. And really what's important today is that you sit down and you really evaluate the trade-offs. So what are the trade-offs when you look at the various portfolio options? And then lastly, what's really important is that you really understand what are the risk and return characteristics as you look at the various portfolio options. And I think as was mentioned earlier, you have the opportunity to go ahead and make a decision, but you also have the ability just to say, let's just wait, you need to hear more information, and really push that off into November. I think it's important that the investment committee, you'll need to consider several important strategic tools in order to make a meaningful difference in terms of providing downside protection without degrading the overall expected return for the plan. And so both PCA, you'll hear and you'll see is that both PCA and Makita, in the models, they ran their models, and what they found was that an increase to the private asset classes, as well as an addition to what we're calling risk mitigation strategies, will make a meaningful difference. And what staff has been doing within the innovation program is actually running some of the strategies that we're proposing for this risk mitigation category. And so we came to the same conclusions that the consultants came to. So what we're bringing to you today is from the consultants. Go ahead.
I'm sorry.
Okay, that's good. Go ahead.
Thank you, Mr. Tom. Can you just go back 2 sentences and
Sure.
repeat what you just said? I thought that it was critically important. I want to make sure I heard it correctly.
Okay, when I was referring to, can you just,
Alternative asset classes and the innovation.
yeah, so
and the
what I was,
recommendation by
sure,
the
if you're happy to,
consultants.
yeah, just to make sure we're on the same page. So what I was referring to is that one of the important things that the committee will need to consider is other tools that you want to bring into the portfolio that will help with the drawdown protection, provide drawdown protection, but without degrading the overall expected returns. So as a result of the modeling is what both consultants, you heard from both consultants, what they found was that number one, an increase to private assets, and then the addition of a risk mitigation asset class or category will help with that goal. So my next sentence was, what I stated was that for risk mitigation strategies, that within the innovation program, we've been running actually some of these strategies live. And so for example, in global macro, we actually have over a 3-year history now. And then with CTAs, we actually have about close to a year now.
Just as a follow-up, and I don't mean to interrupt your
No,
stream of thought.
please.
But I want to make sure that my reading of the reports is accurate.
Okay.
So you're talking about the innovation portfolio that we went through this whole process. I was fortunate enough to be on the board when we adopted that asset class, and you began to do some work in that space. The performance of that innovation fund to date, has it met expectations, exceeded expectations, or has not met expectations relative to returns?
Harry, if you don't mind, can we I'll answer your question in a second. And actually, after I give some introductory remarks, we can share some performance results with you.
I just
Okay.
want to make sure that my reading of the
Sure.
reports is accurate, because
Sure.
you're talking about a recommendation that may grow in the future. So,
Sure.
Okay.
I can give you some
Thank you.
performance results, and thank you for asking the question. So I just have a couple more remarks. Lastly, what's really important is that we want you to make sure that you're comfortable and you're fully educated. We realize that some of the things that we're introducing to you today it's new. So I understand that from your perspective, you really want to understand what are these new items, how do they work, what is their role in the portfolio. And the consultants as well as staff is here to answer any questions that you may have, okay? And then lastly, if an allocation is approved, we would bring back to you a timetable and work with you in terms of how fast we think we can bring up the program. So with that, I want to turn it over to Carrie Lowe, and she wants to just share a few results with you.
Yes, given that risk mitigating strategies is a new area we haven't spent a lot of time on, I did want to highlight the 2 strategies that we have incubated in the innovation portfolio, which are global macro hedge funds and CTA, or trend following hedge funds. And by many counts, you could say that there are more than 20 hedge fund strategies. We focused on just 2. And we identified those as having the most diversification potential to our total plan and the most potential for protecting capital during downturns. We saw that this was the case in the last 2 equity bear markets in 2008, as well as after the tech bubble burst. And we have seen it live in our portfolio. So I would say that it is performing as we expect. Year to date, now that there's more volatility in the market, the equity bull market's getting very extended. Bonds have also run up quite a bit. We've seen year to date, the equities as of last week were down 6%, and our macro CTA portfolio was up 6%. So you'll hear from the 3 parties today, both consultants and staff, to support investigating these risk mitigating strategies further as we approach our November decision.
So with that, I want to invite both consultants up.
So we've got Stephen McCourt from Makita, Alan Empkin from PCA, Neil LaRue.
So I'm going to ask Alan Empkin and Neil Rue to go ahead and lead off.
You have my sincere apologies for the amount of information that has been dumped upon you. But not having done that, we could not have addressed the concerns that this committee raised. And you raised issues from the impact of fees to drawdown issues that many other institutions haven't really addressed. And the only way to do that was to do a very, very lengthy background paper. And I apologize for that. The goal of our PowerPoint presentation today is to give you a brief summary of that very, very lengthy document. And hopefully, with Steve and with your staff, to set an environment that can help you address some of these questions. As someone who's gone through this now for over 34 years, the single most important message I can give you today is there is no urgency. The single most important thing we can do is help you establish a level of comfort so that this decision, which is the single most important decision you will make on the investment side of the portfolio, is something that you feel that no stone has gone unturned. And whether it's November or February or next June, it's better to go slowly and thoughtfully and address those questions than it is to reach a quick decision.
Agreed.
Let's see if, no. Here we go. Okay. We stole, with their permission, some language and some bullet points from Bridgewater. Bridgewater is a very large investment management firm based in Connecticut who does some of the more thoughtful thinking, in our opinion, in the investment community. And they raised 3 issues. And we believe these are the 3 issues that you as decision makers need to address in terms of strategic asset allocation. First is, what is your required return? Second is, what's realistic? What's achievable? I mean, you could have a required return of X, but if the markets aren't going to generate X, there's a disconnect. And then an area that has received far too little attention historically, and that is, how big of a loss along that path can you take and still get to your objective? And the reason for that is really very simple, and that is the actuaries assume you're going to get 7.5% every year. Well, you'll get where you want to go if that's attainable. History has proven the one thing we know you will not get is 7.5% every single year. I will bet everything on that. You may not hit 7.5% once in the next 30 years, and that may well be your average. But getting to that average, if you take a really big hit in the early periods, you may not be able to recover from that. And so we emphasized, how do we minimize the potential for that to happening for your consideration? Okay, so the question is, and I'm going to read this, it's important, can a return lower than 7.5% allow us to achieve our objectives? If the objective is to be fully funded and to maintain the current cost structure, the answer is probably no. What is the achievable return? And how confident are we that that's realistic? And I'm going to cut to the chase because it's been a long day. Using the traditional asset classes, publicly traded stocks and bonds, using the assumptions that we've used, you cannot generate 7.5% unless you put all of the assets in equity-related securities. And then what happens along the way, particularly in the early years, if you have a single year where you go down 10, 15, or 20%? This graph, in large part, is based upon the Department of Finance's projections, and it shows the improvement of funding over a very long period of time, and then the degradation of funding, and then the impact of the new contributions. What's important to keep in mind is that before those new contributions in the funding path, which is the dotted line, improves, it continues to go down. It continues to go down assuming that you make 7.5% a year. If you don't make 7.5% a year, the slope of that curve becomes more acute. And it's just very, very important to keep that in mind. What we've done here is we've shown you the dotted line, which is what you would hope to get using the funding and getting the 7.5%. We've used that red line, the 64% funding level, because if you go below that, the ability to earn your way out of it, even with the new contributions, becomes problematic. So what we did was we spent a lot of time trying to figure out ways to get a combination of a return of 7.5% with a strategy that has a lower probability of dropping before the 64th percentile of funding. That was the intent. The goal is to maintain the positive slope over the long term so that sometime in the future, the benefits are secure, the assets are there to pay all the benefits that are obligated at the costs that have been assumed. And also to avoid, particularly in the early years, big losses, because the ability to recover from big losses in the early years is really challenging. The different policy options address this in different ways. The question that we and you are challenged with, is there potentially a better solution in current policy? And I'm going to underscore the key word there in potential, and that is we don't know that the assumptions we've used, particularly for that risk mitigating asset class, will be realized. And they're based upon judgment and deferring judgment on security selection, asset selection to third parties. Your staff has done a great job in those asset classes or sub-asset classes in the near term, but we don't know what the future will give, and so we have to be humble. And that's why we say it may be. To accomplish that, you're going to be forced to look at things that you haven't done before. And that represents a question of what you believe in. And I know that there's going to be a discussion in your retreat next month on investment beliefs. And I think some of these concepts really need to be based upon what you believe. Do you believe there can be active management? Do you believe it's just beta? Are you willing to pay higher fees to get certain types of expected returns? And there's not a right or wrong answer. Reasonable people could reach different conclusions. The key is to ask the questions. And for you, collectively, to have a consensus. Neil, why don't you discuss this one? Yeah, I hate this chart. Yeah.
Well, with this chart, we're trying to cut to the chase a little bit in terms of different portfolios that you could look at. We explored about 100 different portfolio options, and we try to walk through a funnel to narrow out those choices down to allow you folks to have something that you can look at and compare. And so what we're doing here is we're saying we came up with 4 portfolio options versus current policy that addresses your various concerns. We color code it, green, yellow, red, based on whether or not they do a better job of addressing the concerns than current policy does. And you can see among these 4 options, there's trade-offs involved. So with portfolio, let's see if I can remember this correctly. If you look down through let me just go through these this list here. You've expressed a handful of concerns over the course of this project. One is, will we be able to achieve our long-term funding targets, number one. Number 2 is, as Alan mentioned, will we have to deal with near-term funding risk that might impact the probability of us achieving that long-term journey? What's the expected compound return? Is that going to be higher or lower than 7.5%? Are we going to include this RMS class or not? What is our exposure to growth risk along the way? What's the cost structure? What's the fixed income allocation going to be? And so we compare these 4 portfolio choices versus current policy. And just to go to one of these, the RMS, you can see that we have two choices where RMS is not included. That's portfolio B and portfolio G. And then there's two choices where the RMS is included, and that's F and I. And the interesting thing here is, as you might expect through this kind of research, this conceptual research, is that on several of the key funding related issues, the inclusion of the RMS provides a benefit. So you look at portfolios F and I, where the RMS is included, these portfolios produce a better long-term result. They do a better job, at least a potentially better job of improving your downside risk. You end up with a better long-term compound return. With portfolio F, you end up with lower exposure to growth risk if you're concerned about that. With portfolio I, it's a slightly different matter. On the other side of the coin, these things will be more expensive to implement than maintaining your existing policy. And at the margin, the fixed income allocation is likely going to have to be reduced to fund the RMS to some degree. And then the other two portfolios, primarily portfolio B that we've looked at pretty closely, is that if we're trying to maintain downside risk as the primary goal, it says funding protection under primary goal there, then there's probably going to be a trade-off when you don't include this other class. You're going to have to give up some long-term return. That's going to challenge your long-term funding progress at the margin. So when you don't include the RMS, there's a trade-off involved versus if you do include the RMS, it looks like you can have your cake and eat it too. And that's where both consultants and your staff agree that utilizing the RMS would be highly beneficial in the long term to CalSTRS. Go to the next slide. These just sort of are verbal characterizations of the differences that you're seeing among the policy options. And if we flip to the next slide, this shows some of the underlying data, and there's plenty of data in our report on these different options. I'm not going to. We'll probably in your questions we'll probably get to some of these questions, so I won't hammer it home. If you look at the bottom lines here that we've bolded, these are sort of the projections that we really focused on. Is where will you be in 30 years from a funding progress standpoint, i.e., maintaining what Alan described as that dotted line. This is the end result of each of those portfolios. And you can see that under current policy, based on how we all expect the markets to behave, the current policy will lead you, hopefully, to a funding outcome of being 91%, having a funded ratio of 91% after about 30 years. Yeah. Now the challenge with that is that right now, the current policy indicates under current policy, you have about a 30% chance of falling through 64% by 2019, which is sort of a key year. If you fall through that 64%, you could end up being on the journey you just left with the agreement with the state. And we don't want that to happen, and that's sort of the near-term concern. So if we can improve on those probabilities in the near term, that's very beneficial. So now if you look, for example, at portfolio F, the long-term outcome seems to look better. You'll end up hopefully around a 95% funding, and you cut that downside protection, I would say significantly, from about 30% to less than 25%. So you do improve the short-term probability to some degree with going to a portfolio like portfolio F, and if you look at the allocation, which we can talk about, but it has a significant allocation to RMS among other things. So there's some data there. I know we'll get into it, so I'll just stop right there in terms of some of the choices that we want you folks to look at.
Okay. Can I just let Frank jump in there and then Arena, and then we'll get back to you, Alan?
Yeah, your analysis includes a total of actually 8 portfolios. How do you get from the 8 down to the 4 that are in this slide? What happened to C through D? Why were they eliminated?
I think the quick answer is that there was discussion and debate among the PCA senior consultants. So it's a little bit subjective and qualitative, but all of these, the key here is that all of these are pretty much, if you look at the commonality among portfolios B through I, they lead you to, there's really a focus on the downside risk measure there, the probability of having that near-term outcome. All of them are equal to or lead you to an equal to or better result in the near term.
So maybe the answer to this question is here, and I'm just not making the connection, but on the probability of the 64% in 4 years, what factors are driving that in these different allocations? And part of why I'm asking the question is that the RMS strategy requires an implementation period that appears to go even up to 3 years, and so I'm having a hard time understanding.
That's fair.
Yeah, so maybe you can.
I mean, just, I think that's a very fair question, and the assumption on that is that the RMS is implemented right away. So you'd have to take that into account a little bit. I guess the way to describe that would be, once the RMS is implemented, then these probabilities take into account are more realistic. Go ahead.
I want to strongly underscore that the way the RMS is designed and implemented is subject to change. In our mind, the key is conceptual. And the concept is, are you going to try to look at a different way of solving for mitigating downside risk? And if so, then you send all of us to work on coming back with the best way, the most cost-efficient way, and the most likely to succeed way of obtaining that objective. But you have to feel comfortable with that. I don't think we are going to give you enough information today to make you that comfortable. At least I hope that's not the case, because I think we need to prove it to you. But our concern is you have that path. We want you to continue on that path and minimize the likelihood that the path, you will go away from that path. And the only way to do that, using the assumptions we are using now, is to do something different than you're currently doing.
And let me just put one. And one data point that we found is that if you do end up being at a 64% funded ratio 4 or 5 years from now, right now your probability, the current policy says you have a 30% chance of getting there. If you end up there, for whatever reason, whatever portfolio you have, you then have, for the next 25 years remaining in sort of that horizon, a 40% chance that you'll be below 64% at the end. So it's just that's just a very big probability that we're concerned about in terms of, do you want to end up returning to that negative path? And we're trying to minimize that aspect.
We're done right now. Yeah, pass this down, please.
So let me get Tom, and then maybe we'll hear from Stephen.
Appreciating what you're talking about in terms of more downside risk than maybe we'd anticipated. What specifically has changed in your thinking from this asset allocation exercise to the last one, where we pretty much fell in line with your guidance?
The biggest single change was the commitment of the state to start making massive infusions of capital into the budget, and recognizing that was based upon certain assumptions and trying to maximize the likelihood of those assumptions being realized.
The budget wasn't.
Not sure I'm following. We were, before the state made that commitment, are you saying this gives us more, without the commitment, we had to stretch for more yield, more return?
That's accurate.
Okay, and now we're saying we have a little bit more cushion, so we can be a little bit more cautious.
That's the concept.
That's good, good.
Harry?
My question's along the lines of Mr. Unterman's. I really wanted to know from our consultant's perspective, do you see anything that has changed dramatically or considerably in the world for us to deviate considerably from the current asset allocation that we have embarked upon? And would a prudent person simply say, we're going to stay the course throughout this next process or period of time?
Well, I think that most of your peers will stay the course, so I think it would be inappropriate for me to say they're being imprudent. I think that they are making a choice on how to manage downside risk. And what we've done is we've put the emphasis on managing downside risk given the unique facts and circumstances of this institution. Another institution with different funding where you might control contribution levels, for example, or benefits, might come up with a different solution. But these solutions are unique to this institution at this point in time.
Paul?
No, it's
Oh,
Stephen.
sorry. Oh, I'm sorry.
Stephen.
Sorry,
That's all right.
Stephen.
Thank you.
My bad.
Harry, I would say probably the only meaningful thing that's changed that would that should cause people to look at a different asset allocation from a capital market perspective is the level of interest rates, and relative to 4 or 5 years ago. And with interest rates as low as they are now, that does mean that bonds and most other asset classes have lower forward-looking returns, and that may have implications on how you set your mix of assets. But as importantly, and speaking more specifically to the risk mitigation strategies, bonds historically have been the sole way that pension plans have mitigated downside risk historically. And the cost of holding bonds is now higher than it has ever been. And so that doesn't make it imprudent not to pursue these strategies, but I think it does mean it is prudent to investigate the use of them where it may not have been necessary 4 or 5 years ago.
Madam Chair? One last point, Neil thankfully reminded me. For most pension plans for many years until quite recently, they were cash flow positive. And when you're cash flow positive, you can approach risk in a slightly different way because you have the ability to reinvest at lower levels. When you're cash flow negative, losses have a disproportionate impact on the financial condition of the institution. And to show you how it all fits together, part of my presentation when I talk about performance later is going to be that your assets really didn't grow that much. And part of the reason is you have this huge negative cash flow. I mean, you're writing benefits at a much greater level than you're getting income. And so your staff has to learn how to make up for that in terms of both return and risk. And so that whole impact of cash flow is crucial.
So, it's sort of along these same lines, our approach in the past to dealing with risk was to be in fixed income, and that's the way most other pension funds seem to be. And Alan is saying most of them are going to stay the course, and many of them are cash flow negative. That's just the nature of a lot of public pension funds these days. But this seems to be, no matter what your situation is, no matter whether you've got control over contributions or not, this seems to be a much better way to go. I mean, you're just showing us that relative to current allocation of fixed income, that this is a method by which we can maintain our returns and reduce our downside risk. So if that's the case, if it's so clear that there are these strategies that work, why isn't everybody doing them?
Well, it wasn't always clear that these strategies may work. I think 2008 was a big eye-opening experience when we did see double-digit drops in equities, but then macro and CTA had positive returns and double-digit positive returns in some cases. So institutions did find these types of hedge funds more attractive following 08, but they needed to have that type of insurance policy in place before the crisis happened. And then when equities ran up, these didn't look as attractive, but it was still important to have them in place in anticipation. And now more recent hedge fund surveys that have come out have shown that macro is one of the most highly sought after strategies. So it's taken time for institutions to realize this. Some of them are just prohibited from investing in this area, or they can't access it, or they don't have the staff to do so. And but we are seeing increasing trend and interest in the area.
Okay, so I'm just reacting mostly to what Alan said, which is that he thinks most pension funds are going to stay the course. In other words, I think it's we don't have to debate whether the markets are efficient or not. The markets are obviously not 100% efficient, so there's opportunities to take advantage of that. But what I'm trying to understand is you guys are really smart. I don't question that. Why should we have confidence that you're smarter than everybody else? I mean, because that's how we base our investment into active or non-holding the market strategies, is that we've got to believe that the strategy we've come up with is a smarter one based on smarter people doing it than all the other pension funds and institutional investors out there who also have very smart people working for them. So that's my question. In other words, it sounds a little, I'm putting on my skeptic's hat. This sounds too good to be true, that we have figured out a way to eliminate downside risk without sacrificing return, but nobody else has.
It's important because I think language is important here. We're not talking about eliminating. I mean, and we're talking at the margin improvement.
You are absolutely right.
Okay,
Reducing downside risk without sacrificing.
Number two
Yeah.
is, I think if you looked at the large endowment and foundations, they have been deploying strategies like this for a number of years. And so this is not by yourself, where you would be slightly different than large public pension plans. Corporate America, using primarily long treasury bonds and long corporate bonds, has been using this strategy since accounting changes a number of years ago to defease liabilities.
But sacrificing return.
Right, but their objective there was an accounting and balance sheet issue. It wasn't how to maximize return. Right. And they were trying to lock in costs and minimize the potential for the corporation to have to make additional contributions. Effectively, that's what we're trying to do here, is how to minimize the potential for there to be increased costs to the employer and or the employee going forward. That's the goal.
I love that. I'm completely with you on that. I'm just asking questions. I mean, I think the focus on funding status and downside risk and getting below, if 64% is a reasonable number, and I trust you guys that you've modeled that out, that makes a whole lot of sense. I'm just trying to understand, you know, there is no free lunch unless we're really smarter consistently over time than everybody else in the market, and I've never seen that. So I'm just trying to understand why this works, and more than that, I guess what I'm really trying to understand is what would be the downside of pursuing this? I mean, maybe it doesn't work, but it leaves us where we would have been anyway.
Right. The downside, Mr. Rosenthal, it would have cost you a heck of a lot of money and you didn't get what you paid for. Okay? These strategies are more expensive. Right. We underscored that. We don't want to minimize that in any way, mean, or form. These are more expensive strategies. We think they can work, but notice I caveat that. I don't say they will work. I say they may work. And the challenge is really not to say today, yes, we are going to do that, but yes, we want to learn more about this. It is very complex. There are lots of risks. Do you believe as a group that these types of strategies are really worth pursuing as part of the asset allocation process?
Yeah, because I think, you know, one thing that I think we should be aware of, and it's a question I asked Alan and got an answer about today, is you know, we have a very highly actively managed portfolio if we go in this direction. You know, we're already very actively managed because of a large allocation to other private assets, such as real estate and private equity. And we would be, I think, with one of these portfolios, I think it's F, almost 2/3 actively managed, assuming that all of our fixed income and global equity portfolio is assumed to be passively managed, which it's not. So just, you know, we've got a large reliance on identifying smart people to manage our money in a smart way.
I don't see anything else
So
on here.
but I guess if we were to pursue this more, I would like to see if there's a way to understand what would be the downside if these strategies didn't work. If we have a way of, you know, in other words, you've got an idea about how they work if they work, but do we have an idea of how they don't work if they really don't work? And is that just
Yeah,
the
no,
same
that-
as?
That, in fact, is one of the outputs of the model. I mean, we have distributions of returns and funding
Well,
levels.
No, you have redistributions of returns, but of all the other asset classes. I'm just trying to focus on what if this asset class doesn't, because you're still assuming that this asset class probably works as it's supposed to in a down market, and therefore that's why we have less downside risk, right? What I'm saying is if we have a down market and these strategies don't work to mitigate risk. In other words, what if we're modeling the way these this RMS asset class works? What is the downside? Is it any worse? Is it any worse than just being? And if it's not any worse than just being in fixed income, well then it seems like a worthwhile thing to try.